Good day, and welcome to Max Financial Services Limited's Q4FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amrit Singh, Chief Financial Officer for Max Financial Services Limited and Max Life Insurance Company Limited. Thank you, and over to you, Mr. Singh.
Thank you. Good morning, everyone, and welcome to our earnings call for the quarter ended March 2023. Our results were made available on our website and as well on the stock exchange on Friday. And today as well, I'm joined by Prashant Tripathi, MD and CEO of Max Life Insurance. I will request Prashant to share the key developments of the quarter and hand the call to Prashant. Prashant?
Good morning, everybody. Thank you, Amrit. I'm pleased to welcome all of you to today's earnings call. I would like to provide you with an update on the performance of Max Life Insurance and our strategic initiatives that we discuss every quarter. Before I jump into the performance of last quarter and last year, I would like to give you some review on how Max Life Insurance has performed over the last few years. Max Life Insurance has consistently established a strong market presence since its inception. Upon reflecting on the last 5 years, we have achieved robust results across all aspects of our business. Our sales have grown at a CAGR of 13%, surpassing the industry average growth of 10%. Our crop channels have experienced an impressive CAGR of 21%, while bank insurance has grown at 11%. Over the course of 5 years, we have tripled our retail protection business while maintaining a leadership position in online protection. Furthermore, our assets under management have grown at a strong CAGR of 19%, demonstrating our sound investment philosophy. At Max Life, we believe in striking a balance between our sales performance and value creation, resulting in consistently favorable financial outcomes. In the past 5 years, our operating embedded value has grown at a CAGR of 20%, and the value of new business has grown at a CAGR of 24%. This emphasizes our commitment to delivering value to our stakeholders. Our success is not only evident in our ability to effectively reach our customers, but also in the trust they have placed in our company. This is exemplified by a claims paid ratio of 99.34 at the end of FY22, which is the highest in the industry. Additionally, we assess our performance in terms of customer experience using the globally recognized NPS metric. Over the past 4 years, our company's NPS has improved by 17 points. The steady improvement in our brand consideration score further highlights the strength of our brand within the industry. We have continuously pursued innovation and introduced pioneering business models. Our crop channels are prime examples of our commitment to pushing boundaries and staying ahead of the curve. Moreover, our industry-leading product offerings have positioned us as a leader in the market. With Axis Bank becoming our promoter, our partnership with them has further strengthened our distribution capability. Against this backdrop, let us now shift our focus to the significant developments we have witnessed in our key strategic areas over the past year. Firstly, let me focus on predictable and sustainable growth that we've always aspired for within our distribution. Building on our legacy of consistent performance, we entered this fiscal year with ambitious goals and a strong determination to delivering further growth. The new business premium witnessed a growth of 13% to reach 8,960 crores for the year. The APE growth for both financial year and Q4 stood at 12% and 38% respectively. This growth was primarily fueled by our investments in various initiatives across crop channels, yielding positive outcomes, with them experiencing a strong annual growth of 43% and Q4 growth of 90%. Within the online sales space, we have maintained our leadership position in the online market for protection and have successfully expanded the savings business this year. As a result, our online business has witnessed a strong growth of 44% in FY23. Also, our online savings portfolio has grown exponentially, increasing 5 times over FY22. In the offline channels, within the proprietary space, the offline proprietary have displayed strong growth of 43%, encompassing both agency and direct channels. We introduced simplified and competitive value propositions during the year to structurally enhance the performance of our advisors. This initiative has yielded fruitful outcomes, evident in the growth of our top advisors by 60% year-on-year and advisor activation increasing by 10% year-on-year. In the direct channels, our direct channels have exhibited a noteworthy growth of 36% year-on-year. This growth can be attributed to manpower additions along with improvement in activation and productivity through strengthened governance and the implementation of new business models. Our bank channels APE have degrown by 2% for the full year. However, in Q4, banks demonstrated a growth of 13%, showing signs of revival. It gives me immense satisfaction to see that despite the challenges posed by the open architecture model for the year, we have demonstrated our execution prowess by maintaining our counter share in the bank insurance channel over the 15-month period in Axis Bank at around 70%. Now that open architecture is already settled, we expect that our growth will be consistent with the growth of the bank itself. Our investment philosophy continues to bolster our distribution as we opened up alternate verticals to reach wider customer base in banks. Additionally, we made strategic investments in prop channels, establishing 50 new offices to enhance our presence. Furthermore, we are striking new partnerships with banks and brokers. I would like to announce that we have entered into 2 more new distribution partnerships with DCB and Capital Small Finance Bank since our last update. With this, we have signed up 4 banks, which are DCB, Tamil Nadu Mercantile Bank, Ujjivan, and Capital Small Finance Bank, and 6 brokers in FY23. Overall, these achievements highlight our commitment to driving growth across different channels and reinforcing our position in the market. Going through the second thing, which was product innovation to drive margin. One of our focus areas at Max Life Insurance is to continually innovate the value proposition to our product through our product offerings to our customers. Throughout this year, we successfully navigated the heightened competitive intensity by introducing new products and variants and expanding our new categories. This resulted in an expansion on a YOY basis in our new business margins from 27.4% in FY22 to 31.2% in FY23, and also led to 28% growth in value of new business. We launched a range of products across various categories during the year. Our new non-participating savings product, Smart Wealth Advantage Guaranteed SWAG, achieved a significant milestone by scaling 1,000 crores in sales in shortest time ever. Additionally, we introduced the Smart Fixed Return Digital Online Savings product, which improved our online savings penetration and contributed to a notable growth in online savings sales. On the individual APE basis, our product mix for FY23 consisted of 14% par, 51% non-par, 29% unit-linked, and 6% protection products. In Q4, our product mix was par 11%, non-par of 60%, units of 24%, and protection of 6%. The product mix in Q4 was skewed towards non-par due to the one-time impact of tax-related changes announced in the budget. However, we anticipate the product mix to normalize in the new fiscal year. We maintained a strong belief in the long-term potential of protection and retirement opportunities. In Q4 FY23, retail protection witnessed a sequential growth of 50% as a result of our product interventions throughout the year. Our retirement business achieved a growth of approximately 300% on an APE basis in FY23. We have enhanced our annuity offering by launching a new limited pay annuity variant and extending the early ages to attract new customers. Max Life Pension Fund Management commenced operations in the second half of the year and has garnered an asset under management of approximately 143 crores as of 31st March 2023. Talking about the third thing, which was around customer obsession across the value chain. At Max Life Insurance, our unwavering commitment is to provide significant value propositions to our customers and continuously enhance their overall experience. Over the course of last 12 months, for the period of FY23, we observed an improvement of 3 points in our overall company and NPS scores, increasing from 49 in March 2022 to 52 in March 2023. We take immense pride in maintaining our position as a market leader in terms of 13th month persistency for the number of policies. This remarkable achievement underscores the trust and loyalty our policyholders have with Max Life. When it comes to premium persistency, our 13th month persistency rate for regular or limited pay premium stood at 84%, while the 61st month persistency rate reached 51% for the period ending March 2023. Furthermore, Max Life Insurance was honored with the prestigious rank of number 2 in customer loyalty according to Hansa Research, which is an external report. This recognition is a testament to the trust and satisfaction our customers place in us, highlighting our ability to foster enduring relationships with our policyholders. Our fourth theme of digitization for efficiency and intelligence. I would like to share that during FY23, we undertook numerous initiatives to transition into a fully digital organization and pioneer industry-first digital process. To strengthen our sales force and to ensure superior execution, we swiftly digitized sales governance and lead management processes. To enhance the onboarding experience, we harnessed the power of AI and automation, resulting in increased velocity measured through the paid to applied ratio. We introduced profile-based medical and financial grids as well as KYC waivers for existing customers, enabling frictionless underwriting and instant issuance. We also achieved greater ability in our new product development cycle, reducing new pricing changes just to 2 days, which earlier used to take more than 2 weeks. Additionally, our deep integration with Axis Bank and Yes Bank marketplace ensures a seamless experience for our bank partners with real-time policy status available for both banks and Max Life Insurance representatives. Leveraging AI, we implemented an underwriting governance AI model to maintain underwriting limits and uphold superior risk profiling. In order to enhance customer service, we created a new unified platform to deliver a standardized online payment checkout experience across all customer journeys. This platform minimizes redirection during the payment processes, leading to an increase in overall payment success rate by about 7% for online transactions. We revamped our customer service portal, ensuring a seamless customer experience and providing best-in-class customer support. The introduction of QR codes for customer servicing has facilitated frictionless do-it-yourself digital transactions. By automating and digitizing point-of-sale processes, we have increased straight-through processing rates. Continuing our focus on agility, cost efficiency, and scalability, we transformed our IT infrastructure to cloud-native apps and services. Currently, about 56% of our entire IT infrastructure operates on the cloud, which is 10% more than last year, enabling us to achieve greater flexibility and scalability. These initiatives highlight our commitment to embracing digital transformation and leveraging cutting-edge technologies to deliver enhanced experiences to our customers while improving operational efficiency. Lastly, we are excited to mention about some of the key notable recognitions which Max Life Insurance received through the year. Max Life was recognized as one of the best BFSI brands by Economic Times in FY23. Max Life also earned recognition for excellence in financial reporting by Institute of Chartered Accountants for its annual report, and was also awarded the Talent Model Insurance Award for 2023 for its digital initiatives in data analytics and AI. Max Life was also awarded excellence in driving distribution through digital at the FICCI Insurance Industry Awards for 2022. In summary, we effectively navigated the year by achieving remarkable growth in our prop channels while simultaneously maintaining our counter share in our bank insurance part. This success can be attributed to our focused strategy regarding product offerings and enhancing the value proposition for our customers. As we move into FY24, we remain absolutely optimistic about sustaining this positive momentum. I'm now going to hand it over to Amrit, who is going to share some updates about our financial performance. Over to you, Amrit.
Thank you, Prashant. Moving to some key summary financial metrics. For MFSL, consolidated revenues excluding investment income stood at rupees 24,940 crores, a growth of 13% in FY23. The consolidated PAT was rupees 452 crores, up by 42%. Max Life renewal premium grew by 13% to rupees 16,382 crores, and gross premium grew by 13% to rupees 25,342 crores. The value of new business written over the period, as Prashant mentioned, stood at rupees 1,949 crores versus 1,528 crores for the previous year, representing year-on-year growth of 28%. The new business margin improved from 27.4% to 31.2% in FY23. For Q4 FY23, the VNB was rupees 770, a growth of 31%. Embedded value as at 31st March 2023 is rupees 16,263 crores, an operating ROEV of 22.1%. The policyholder OPEX to GWP was at 14.2%. Max Life FY23 profit before tax is rupees 505 crores, an improvement of 21%. Profit after tax is rupees 435 crores. Max Life solvency ratio stands at 190%, and the AUM at end of 31st March 2023 is 1.23 lakh crores, and year-on-year growth of 14%. To conclude, we remain confident in our ability to leverage our strengths and deliver sustainable value to our shareholders and customers. We remain committed to the purpose of inspiring people to increase the value of their lives. We are now happy to take any questions that you may have, and I will now hand over to the moderator to open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah. Hi. Good morning, Prashant and Amit. I mean, very, very strong performance for Q4. Now, the first question is like on the growth outlook for FY24, considering the base effect, whatever happened, the taxes and changes that had happened, and your own channel, the proprietary and banking, their dynamics. If you can please help to understand how the growth will look like in FY24 for you, and if any color sort of like on your channel on product mix in that part. And the second question is, of course, it will be on the process, but as far as the stake, 7% stake transfer in Max Life to Axis entity is concerned, where are we in terms of the process of getting the value, getting the valuation done, approaching the regulator, and any kind of broader timelines on that, okay, when and how the progress will be made? So these are my two questions. Thank you.
Avinash, thank you very much. Good morning to you. Firstly, the question on growth rate, very valid question and very pertinent. Becomes even more relevant in the context of artificial growth that came in Q4, especially in the month of March. But I'd like to highlight all of you that we have an advantage in terms of base effect, considering that we were going through open architecture for a large part of FY22-23. And that advantage is going to kick in, and hence we expect the FY24 growth to be a double-digit growth, a reasonably good growth, and perhaps a higher growth than what we saw in FY23. So that's on growth expectations. We remain bullish and we remain optimistic, and we are preparing for robust growth for the year FY24. On your question on further investment of 10% by Axis Bank, of course, Axis Bank has prepared and seek all the approvals within their own systems, and especially around capital that is required. And that process is on, and quite hopeful that the transaction will take place in the financial year FY24. Telling you exactly which quarter or date right now is a bit difficult, and we will just wait and come back to you when that plan and the date timeline is fulfilled. However, suffices to say that they have shown their commitment and that announcement has been made, so it's only a matter of time when it happens. The valuation will become relevant only at the time of transaction, so really we will do that valuation at the point when Axis Bank is ready to make the investment. So overall, from the growth perspective, we remain bullish, as well as, you should expect this transaction to take place in the financial year FY20.
Thank you. And just quickly, one now, Tata AIA has sort of got, by the virtue of merger of Citi and Axis, Tata AIA is present at least in Citi. Now, does that kind of, is there a sort of understanding how this is going? Because, so earlier you were three players, now you have regulation permits, and at least in Citi branches, Citi customer Tata AIA gets entry. So, does this changes any kind of a competitive dynamics in your channel, or it is like that, okay, they are going to stay with, as it is, the Citi branches, Citi customers?
Yeah, Avinash, that's a very good question. And, I think the relationship with Citibank and Tata AIA is just going to continue the way it continued earlier. With respect to competition, I think Axis Bank is an open architecture platform. So from that perspective, we have competition, and I would like to very confidently share that we withstood that competition quite effectively by maintaining a large part of counter share at the bank. But I think at a very high level, Axis Bank is our promoter, and hence you should expect that Max Life Insurance will continue to enjoy a very large share of their counter in the range of about 65 to 70%, very optimistically, for even if additional competition were to be added. So at a very high level, I think as management, we remain bullish on our growth at Axis Bank.
Thank you. Very clear. Thank you.
Thank you. Next question is from the line of Swarnabha Mukherjee from B&K Securities. Please go ahead.
Yeah, thank you for the opportunity, sir, and very good morning to all of you. So just I wanted to continue on the question of previous participant in terms of the growth. So just wanted to check the
Sorry to interrupt you. You're sounding a little distant. Can I request to speak through the handset?
Sure. Yeah, is this better?
Yes, thank you.
Yeah, so I wanted to ask on the double-digit growth guidance, would this be on the actual numbers that we have clocked in FY23, or should we think of this double-digit growth on the base adjusting for the additional sales that came from the taxation-related product sales in the fourth quarter? So that is one question. Second, on the margin side, sir, what I wanted to understand is that this quarter, as I see, the product mix had moved favorably in the direction of non-par. and despite that, there has been a sequential fall in the margin. So what changed between the last quarter and this quarter? Was there some additional cost that was baked into the cost structure that resulted in this fall, or is there something else to look into? And if you could also give some color on the VNB walk, which I think is not there in the presentation. So between FY22 and 23, what were the various factors that moved the margins? That would be very helpful. And thirdly, so one quick question, if I could add, in terms of the banker channel, I was trying to gauge how the growth would be in terms of, say, the banks other than Axis Bank. So if you could give some color on or some quantitative matrix which would help us to understand the growth in this channel.
Thank you, Saurabh. I think I will let Amrit answer the VNB question, but at a very high level. I think a lot of people have questions around the growth on total or adjusted, etc. So the double-digit growth number that I spoke about should be on the total base. And why I remain optimistic is, again, just to repeat, for the first 9 months of the year, we had challenges of open architecture which artificially created a favorable base for us. So, next year we are going to take advantage of that base effect. And hence the double-digit growth rate should be on the total basis, not on adjusted basis. I'm sure in this group there will be many people who will have questions about what would have been our growth rate adjusting for the extra sales that we got. So just to clarify and answer this question for everybody, we got about between 300 to 350 crores of additional sales because of one-off effect over and above the run rate of greater than 5 lakh policies. So if we were to adjust for that extra sales that we got, our growth rate, which we're reporting 12%, would be in the range of about 6-7%. So we got about 5-6% of extra sales because of that one-off. Responding to your question on why the VNB is lower, just to clarify, because it comes from non-par, large part of non-par, and you would have seen our non-par percentage go up. On large ticket sizes, one expects a lower margin, and hence, we made appropriate assumptions for the large ticket sizes. The large ticket size margins are lower than smaller ticket sizes, so that's the reason why you would see a reduction in overall VNB, overall margin for the quarter. I'm going to hand it over to Amrit to talk about the VNB walk, but as far as I remember, we have the VNB walk. Amrit, you want to take that question?
Thanks, Prashant. I think, Prashant, you've answered Swarna's question, which was around why the sequential quarter the margins look lower than how it was. So one is the high ticket case size margins, which actually have been considered. Second, also, this is a full year of run rate spend which is building up. We have been indicating that we are investing towards our distribution capability and capacity creation. So that cost, as it kind of builds up, has some drag which has got created. And thirdly, when the launch happened in Q3 of our new product, the swag product that Prashant spoke of, there were certain variance mix that kind of existed in the first few months, which kind of normalized. So a little bit of variance mix drag also has come into the margin. And from a walk perspective, it's largely related over a year-to-year period. It is related to the mix of the non-par of being of higher proportion, which has actually helped improve the margin profiles. Does that answer you, Swarna? Hello?
Swarna, may I request you to unmute your line from your side, please?
Yeah. Amrit, that answers my question. I was looking at it from more quarterly standpoint, and I think Prashant is already highlighting that. Yeah. Thank you so much for that. And if you could address the question on the banker channel.
So I think on bankers, one of two things. One, as Prashant mentioned in his opening remarks, we have signed up partnerships with 3 banks and over 67 brokers. So this is incremental volume for us as we look to kind of gain counter share at some of these places. With our existing counter share banks, which is Axis and ES, our endeavor will be to maintain and hold on to our counter share And as the bank growth rate kicks in, the consequent growth rate to Max Life will start appearing as well.
Sure. So I wanted to understand, sir, if you could highlight, any growth numbers for the non-Axis channels so that we can gauge the performance of this.
I think right now you're starting from a zero base in some of those partnership relationships where anything that you'll add on a small base will look like a very large growth number. So our intention would be to gain as much counter share given our capabilities and powers that we have demonstrated in bancassurance channels. So I'll leave it at that.
Sure. And just I just wanted to know if you are maintaining your product mix guidance and margin guidance which you had mentioned previously, or should we see some kind of uplift to that for the coming week?
No, I think firstly, as the high ticket sale happened in the month of March, it did swing the proportion of non-par on a higher side, and we do expect a moderation on that to happen, which would mean that the long-term guidances that we have been given around margins, which is a reduction in margin profiles, will happen. I think the way you should see it is that the bias and focus is towards driving growth and regaining market share. And towards that, there will be an investment which has happened and will continue to happen, which along with some moderation of the non-par mix will mean a drag on the margins.
Got it, sir. Very helpful. I'll come back in the queue. Thank you so much.
Thank you. Next question is from the line of Sanket Goda from Avendus Spark. Please go ahead.
Yeah, thank you for the opportunity. Amrit, the question which I had was that the economic variance number at around 1,040 crores, which is almost 7.4% of the opening EV, seems to be very high compared to our EV sensitivity to the interest rates. What we tell is around 1%. Even for equity, it is relatively low. So just wanted to understand what led to such a high economic variance number, given our sensitivity table doesn't suggest it to be so. So and if you can break down this economic variance number, is it because of equity or bonds, or there is something kind of a one-off in it?
Yeah, I think a great question, Sanket, and I think thanks for pointing it out. You'll understand that EV sensitivity is an assumption of a parallel shift in 1% across the yield curve. Whereas the non-operating variance is this is actual shift which happens, and obviously the reality versus that simulated shift is slightly different, and that's how it looks different. And that's probably the disconnect that you're feeling in your mind. But out of this 1,000 odd crores of non-operating variance, almost 900 plus is coming out of interest rate movements, and that also the short end of the movement which has happened in the month of March.
Okay, but there is no gap in the hedging, right? So that led to that.
No. Hedging, we continue to run our hedging program as we have been running.
Got it. And
you know that this is transitory in nature, given we are hold to maturity. These are the market movement which will keep coming, and some of this variance that you see is all transitory.
Yeah, I understand that. Thanks. And because the number divergence was decently big, so I was just intending to ask that question. Yeah. And the second one was that in the non-par book, which is around 48% of the total AP for FY23, just given you have just highlighted the growth number for annuity around 300% year on year. But if you can break down this 48 into pure non-par and annuity, that will be useful because we understand that non-annuity portion of that non-par might see a mix change, but how you see this annuity portion to play out, and that mix you expect to play out in 24 as a margin buffer.
So annuity continues to remain an area of focus in the overall umbrella of retirement focus that we are building as an organization. And you would have noticed that our annuity mix, which was around about 1% last year, has moved to now around 5% in the overall mix. So in the 51%, 48, I think we are referring to including GCL, 48, around 5% is annuity mix. And we will continue driving annuity business in future as well.
Okay. Okay. And the last one, it's 31.2. Means I think Sonam has asked that question. The 31.2 is the margin in the current year, and you highlighted that non-par will come off a bit, and margin should take a moderation. Should we assume that it is going to back to like 26-27% kind of a number, or you think at least it could be better than that in 24? Whatever product mix it takes as a shape.
Yeah, I think it should remain. We have been indicating 27-28% as stable margin profile, so you should consider in that range.
Okay. Thanks, Amrit. That's it from my side.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Good morning, Prashant and Amrit, and congratulations on good results. One question around the promoter holding. Like this quarter, we have seen some reduction in promoter shareholding. So how do we see that? And any thoughts, therefore, around the promoter structure going forward?
Yeah, I think it's something that's on the private side, and for the promoter continues to remain committed towards this business. And some moderation, some reduction has been done, but overall his long-term intent and kind of continuing building the business remains consistent.
Okay. And just on the margin, one clarification: will first quarter again we will see a seasonal decline in margins?
We always report our margins from a quarter-to-quarter basis on cost, actual true build-up of cost, and largely the sale of the first quarter is far lesser than the sale of the consequent quarter, and the cost is equally loaded. That natural impact always plays out. So this is not unique to us in this fiscal. This has predominantly been like this for many years. So our first quarter margins always will come up, despite the product mix, which largely due to the fact that the spend is actually uniform across the quarters, and which creates a drag.
Right. And on the solvency ratio, now we have seen a 10 percentage point drop this quarter. How do you see that? Will this transaction also aid solvency ratios as it gets completed, and how much will that effect be?
So I think firstly on solvency, you would have noticed that the regulator did provide additional mechanisms of capital as well, which has given for insurance company an additional buffer of up to 50% of the net worth as additional debt that can be taken, as 25% as an additional debt that can be taken. But in addition to that, now from an Axis perspective, I think both primary and secondary options are in consideration, and we will announce it closer when Axis actually completes its internal processes of when and at what time they want to do up to 7%.
Okay. And lastly, on this 300 crore one-off sales that Prashant talked about, so does this only include ticket size above 5 lakh? Because there will be customers who might have bought lower ticket size because of the tax rate changes, and they may look to add additional amount later on. So they may not have crossed the 5 lakh threshold in this month, March. So how are you looking at that?
So it's computed on the 5 lakh trend line only. This is past trend line to current trend line. Whatever has incremental come off, Prashant indicated that range.
So it's only about 5 lakh, the 300 crore number.
That's right. In the traditional policies, the par and non-par designs.
Right. Got it. Okay, sure. Thanks so much.
Thank you. Next question is from the line of Neeraj Toshniwal from UBS Securities. Please go ahead.
Hi, I'm audible?
Yeah, Neeraj.
Yeah, so wanted the outlook on protection, given everybody, including you and other comms, have, in terms of absolute number, at least, if I don't see the growth has been a little better. So where do we see the growth trajectory going in FY24, and is it real demand picking up for protection segment, especially retail protection?
If I heard your question, the question was, because your voice was very muffled, I couldn't hear it properly. Is it protection growth that you asked?
So I'm repeat. Basically, question is on outlook on retail protection, given there's been some comeback in Q4 for in terms of absolute amount at least. So how do we see retail protection playing out in FY24?
I think a lot of supply, the large part of this construction also happened because of supply side challenges that we went through post-COVID, and rightfully so. And a lot of effort internally has gone in firstly reducing the supply side challenges that exist or the constraints that exist. At the same time, also augmenting using tech and analytics, our underwriting capabilities. I think the way we are set up and how and what all progress that we have made, both in underwriting function, the product design elements of it, and the upfront aspects in sourcing. We feel that now 2 years of low base has set up actually us for growth in the retail protection segment. So we do expect protection business to start growing from this point onwards.
Any color on numbers? I mean, how much growth percentage we are looking for, or how much we can build in?
I think, these are very difficult numbers to kind of give a specific if you get into each segment and products and things like that. But I think on protection, anything less than 20% is not at all aspirational. So we will try to drive for 20% plus kind of protection growth.
And any change in commission payouts post EM guidelines you can witness, or how industry is behaving given after April? Seeing anything changing materially on ground, or it will take time to kind of get to new normal, adjust to new normal?
I think what you need to understand there is that first there is an overall EOM framework where the regulator has an expectation of working towards driving efficiencies in the business, which then get passed on to the consumers. And hence, on EOM perspective, there needs to be optimization which will need to be undertaken. And then under that EOM limits, there are elements of commission. Tactically, there will be certain segments and certain plays where, and also certain types of distributors, depending upon how our internal cost structures and variable structures are. There could be certain changes in commission which can happen, but I think it will take some time for the dust to settle of how things evolve, and we will continuously keep working on this.
Got it. And harping on the same question again on the banca and proprietary growth. So given banca, we are a low base, obviously we have an advantage, but are we really seeing growth coming from Axis coming back? Basically, the problem was that the Axis Bank itself growing slower than the other banca channels compared, if I compare with the with the peers. So how Axis is kind of coming back, and what kind of commitment they are showing getting into FY24, and what kind of growth we can expect to happen?
I will take that, Amrit. Axis Bank definitely is a very aspirational bank. They have big plans for their growth, and insurance definitely is a large part of the fee income. So, it will be wrong for me to say that, Axis will continue to be lower than the industry. I'm sure they will bounce back and they will do industry consistent growth rates or better. So let's keep it at that level. We are very optimistic. We have had internal discussions. We have deployed large plans, and we will execute on them.
Any growth numbers we can, peg to that?
I think I did share with you the growth number that we're aspiring at a total company level, and let's not go down to every channel level. I think it will be collective amalgamation of growth that will come from bank as well as our own channel, which will contribute to a strong double-digit kind of growth numbers from Max Life Insurance.
Got it. But just last on the proprietary, we have a strong base now, given Q4 was really strong. So how do we see? Are we investing more into that, or are we done with the investments?
Yeah, your voice is very muffled up. If you could repeat your question, please.
Are we investing more into the proprietary channel, or are we done with the?
We will continue to make investments. I think we will continue to make investments in our own channels. That's something that is going to continue. For example, in FY24, we are seeking approval to open new branches in the proprietary channels within agency. We are making investments to grow our headcount in the direct channel. We will be making further investments in building our e-commerce channels. We are also experimenting with new models, that we could grow, looking at various sub-channels within the large channels. So, yeah, we will continue to make that investment. But equally, we are making investment in the bank channels also in terms of ramping up our presence, more headcount, looking at alternative verticals within banks. So I think growth is going to be a theme. And we will do whatever it takes, both in bank channels as well as proprietary channels. So there is going to be an all-round focus on growth.
Got it. That is helpful. Thank you.
Thank you. Next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. A couple of data keeping questions. First is, can you share the share of Axis Bank for FY23 in terms of APE?
But if you won't take that question, I don't have the exact number.
Yeah. I think we have been, individual partner level details, we have been not sharing, Nidesh, keeping the partner sensitivity in consideration. But our counter share, I'll reiterate, stays at 70% in Axis Bank.
Sure. Second is that the 350 crore number that we mentioned is for the month of March, right?
Yeah, all of it, the Jan and Feb did not see any fire sale effects. So most of the fire sale effects kind of peaked out in the last 2 weeks of March. And this number that we have given you is for the month of March.
Sure. And lastly, there have been a lot of changes which are proposed in insurance amendment bill, which leads to composite licensing, opening of agency channel, and I think the bank assurance channel has also opened up for now 9 partners. So how should we, how do we think about these changes, and how should we place ourselves favorable to these changes over the next 2 to 3 years?
I think I will take that question. The open architecture, Nidesh, as you know, is more, contextual for bank assurance partners from 3 to 9. And, as far as Max Life Insurance is concerned, all the counters where we operate, we have an open architecture situation. And the good part is our performance has been robust. We have been able to maintain our counter share. I think as we look ahead, I think hence a company like Max Life Insurance has more to gain out of open architecture because, we will be the ones who might be included and less to lose. So we look at this particular thing quite favorably, and it is going to present itself in form of more opportunities in Max Life Insurance. So we have nothing much to lose from it. As far as the agency channels, etc., are concerned, agent open architecture is something which has not been discussed. However, the market in that sense is quite open, and we have been operating quite effectively. Have been quite enthused with the growth that we're seeing in our own channels in agency. So overall, I see the regulations to be more favoring for the overall industry in specific for Max Life Insurance, and hence, our plans are quite aggressive for the next year.
And sir, any thoughts on composite licensing?
We have read about it. That there's a possibility and it can get reviewed as a part of the act. On behalf of Max Life Insurance, we are actively watching this space, and if any such flexibility is available to us, especially in the context of contiguous businesses like health, we will look at that quite favorably with agility and with slightly over.
Sure. And then lastly, and from next year onwards, how should we think about product mix? So non-par share will reduce, but how much of that will be taken up by par specifically?
So Max Life has always believed in a balanced product mix, and but at the same time, we have to be consistent with market also. Really standing away from the market becomes a bit difficult. My sense is that the non-par got favored because of tax regulations, as well as impact on overall share market for an extended period of time. As we move into FY24 and beyond, I think we will see a rebalance. Some part of non-par will go to participating, as well as to some part to ULIP. So from that perspective, the product mix will get more rebalanced, and hence you should expect the 48% to fall and come more in the range of closer to 40% over the next couple of years.
Sure, sir. That's it from my side. Thank you.
Thank you. Next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Hi. Thanks for taking my question. If I look at the proprietary channel, it's been at around 27-28% for the last few years. Excluding FY23, I believe there was some one-off or exception in the last month. So what would probably be this number in FY23, and where do you really expect this to go? I mean, probably we can skip FY23, but where do you really expect this to go in 24-25? I believe in FY18 as well, we kind of made some investments to sort of beef up this channel. But despite that, for the next 4 years, the ratio of this channel has been similar.
Yeah, Nischint, thank you. It's a combination. The mix adjustment is a combination of both things. I think artificially, the bank assurance growth had an impact because of open architecture, so it went down. At the same time, we made investments and we saw significant success through the proprietary channel. So a dual impact on faster growth than normal last year. I mean, if you look at our run rate of growth in proprietary channel, it will be in the range of about 20%. Last year it was 43%. At the same time, our average banker growth will be in the range of 15-20%. Last year it was flat. So a combined effect of both actually has led to out-of channels gaining more and more share of the overall pie. As a strategic measure, we are trying to rebalance our product mix, and ideally we would like to go past 40% of our own channel contribution as soon as possible. I know that it will not be possible to do it very, very quickly, but over the next couple of years, from 2 to 3 years, we'd like to have our own channel contribution go past 40%. That's the direction we'll work in, and hence our plan to grow proprietary channels faster than partnership channel is something that is important to us, and you will see us move in that direction.
And will you call out overruns on this account separately? I think you did that in the past, and that's probably kind of taking the margins to 27, and maybe a combination of non-par will down as well.
It does actually, but once you achieve the scale, the impact on overrun, etc., is not very high. For example, you would have seen us do really bad on margins this year. So I think our overall guidance to remain in a respectable margin range, in the range of 27, 28, 29%, that range, as well as trying to grow our proprietary channels so that they achieve scale, as well as more than 40% share in a short term. And when I say short term, 18, 24 months, that kind of period is an imperative for Max Life Insurance, and we'll work in that direction.
So got it. Just one last question. If I look at the growth in back book surplus for the last 3-4 years, I think it's just at around 10% or CAGR. Probably appears to be a little bit on the lower side. So would you have any comment on this, and does this kind of trajectory pick up, and what could be the drivers?
I'll let Amrit and Ashish perhaps respond to that question. Amrit?
So, Nischint, actually last year was, in the back book, there was some adjustments around COVID, which impacted the momentum of growth. But if you see this year and you normalize for it, the back book has continued to grow at around 20% at levels. Actual growth is 45, but adjusting for the COVID elements of it, which reduced the base last year, the growth is around 20%. I try to understand the question that you are looking at longer trends, and you made this comment around 10%. We'll have to look into that data and we'll respond to you offline.
Perfect. Thank you very much, and all the best.
Thank you. Next question is from the line of Madhukar Ladda from Nuvama Institutional Equities. Please go ahead.
Hi, morning, and thank you for taking my question. So, in the context of tax changes and so much of pre-buying that has probably happened, if I look at the banca channel, that's still only grown about 12.5% year over year, and that's also given that the base was normalized. So last year you were at 70% counter share. This year also you were at 70% counter share. Last year you also had the Omicron impact. So given all this, it seems that the growth in this year, at least from the banca channel, has still been a little bit subdued. This quarter, I mean, last quarter has been subdued. And you're also now guiding for double-digit growth. So what? It's almost not possible without the banca channel, firing up. So what makes you confident now that in FY24 this will happen? What sort of problems are we going to overcome? What is going to change now? Can you highlight that a little bit?
Yeah, I mean, firstly, your observation that the bank should also grow at a double-digit growth rate for Max Life Insurance to grow at double-digit growth rate is bang on. And it is our expectation that our banks will grow at double-digit growth rate. Now, what gives me more confidence is two things. A, the impact of open architecture is out of our way. I think the entire of last year we actually struggled, at least for the first 9 months. We struggled with the impact of open architecture. That was the reality. And it is quite mathematical in nature. Overall pie goes down. I think as we move into the next year, the optimism actually comes from the institutions who are our partners. Axis Bank and Yes Bank, who have the track record of delivering, better than market average for a continued period of time over a long run. So I think some of that does give us confidence, and I'm reasonably sure that it's going to come back up. But at the same time, the success that we've seen in proprietary channel and the investments that we have made will also come back to add to it. And so that's where the confidence comes from. To your question on, some of the demands already being met from, early buying, etc. I think India is a very large country and very large saving pools, etc. Last year, like I mentioned to you, we got about 350 crores of additional sales because of, early buying, so to say, or large ticket sizes. As we move into the next year, I mean, from the overall context of doing 7 or 8 or 900 sales, a 350 crore number is not a very large number. So, I think my sense is, insurance is very fundamental. It is a trusted instrument for savings and investments as well as for protection. It will continue to, be seen more favorably by investors and savers, more so in the context of all the work that the regulator is doing and, trying to make it more attractive. So, that's where the entire confidence Madhukar is coming from, and, I'm very hopeful that it will move in that direction.
All right, so thank you. All the best.
Thank you.
Thank you. The next question is from the line of Sanket Gora from Avendus Spark. Please go ahead.
Thanks for the opportunity again. I just want to confirm again, is it, given Tata has a global tie with Citi, is it automatically means that Tata will get access to entire Axis Bank branches, or it is just open to the Citi branches, what Axis has acquired?
So for the time being, the second one.
Oh, okay. Okay. That's it. Thank you for me.
Thank you very much. I now hand the conference over to Mr. Amit Tripathi for closing comments.
Thank you, ladies and gentlemen, for being on our call. We look forward to more such interactions. Wish you all a pleasant day. Thank you.
Thank you very much. On behalf of Max Financial Services Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.